This is part 2 of the presentation for Module 5 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In this learning objective, we will evaluate the effects of foreign currency exchange rates on revenue. Companies routinely conduct business in foreign currency. Although companies' U.S.-based subsidiaries may write purchase and sales contracts that are denominated in foreign currencies, foreign subsidiaries likely transact business almost entirely in foreign currencies. These foreign subsidiaries not only conduct business in foreign currencies, they also maintain their accounting records in currencies other than the U.S. dollar. Before the financial statements of those subsidiaries can be consolidated with the U.S. parent company, they must first be translated into U.S. dollars. As the U.S. dollar weakens vis-a-vis other currencies, each foreign currency buys more U.S. dollars. When the financial statements are translated, the U.S. income statement grows with reported revenues, expenses, and profit all larger than before the dollar weakened. In the consolidation process, the foreign subsidiary's balance sheet with the weaker U.S. dollars grows as well, reporting higher assets, liabilities, and equity. We will examine the income statement and cash flow effects of foreign currency in this module. Pfizer's income statement for 2018 reported an increase in revenues of $1.1 billion from 2017 to 2018. Pfizer explains in the footnote disclosure that changes in foreign exchange rates during 2018 accounted for $310 million of the $1.1 billion total. This slide includes the footnote disclosure from Pfizer explaining Pfizer's foreign currency exposure. We assume that a weakening U.S. dollar increased revenue, cost of goods sold, and other operating expenses. Because Pfizer is profitable, the foreign currency fluctuations had the net effect of increasing Pfizer's net income for 2018. There are three ways that foreign currency gains and losses can affect cash flow. The first is when the U.S. company transacts business denominated in foreign currencies. A U.S. company might denominate a sales contract in euros, for example. If the U.S. dollar weakens between the date of the sale and ultimate collection of the euro-denominated accounts receivable, the U.S. company realizes a foreign currency transaction gain. Conversely, if the U.S. dollar strengthens, the company will realize a foreign currency transaction loss. Another situation can involve a U.S. parent company borrowing money that is denominated in a foreign currency. If the U.S. company borrows in a foreign currency and the U.S. dollar weakens in relation to that currency, the U.S. company will experience a foreign currency loss because it will need more U.S. dollars to acquire the foreign currency to settle the debt. The last situation is when a foreign subsidiary's cash is repatriated to the U.S. Most foreign subsidiaries maintain cash in foreign bank accounts for use in ongoing operations. If the U.S. parent repatriates the cash, however, by a cash dividend from the subsidiary to the parent, a foreign currency transaction gain may arise if the dollar weakens before the foreign currency is converted into U.S. dollars to pay the dividend. All three of the situations that we have described involve realized gains and losses. However, the gains and losses occurring when the foreign subsidiary's financial statements are translated into U.S. dollars, which we described previously, are unrealized gains and losses. Realized foreign currency translation effects, including repatriation of foreign earnings, are normally small, even though estimates indicate that U.S. companies hold $1 trillion of overseas earnings. mostly invested in U.S. marketable securities. However, the Tax Cuts and Jobs Act removed a major tax barrier to repatriation by allowing companies from 2017 onward to pay a one-time tax of 15.5%, down from 35% on repatriated earnings. Since the new tax law was passed, many companies have started to bring foreign profits back to the U.S. One study found that companies repatriated more earnings in the first 6 months of 2018 than in all of 2015 to 2017 combined. Companies frequently provide guidance for analysts to forecast future income statements, including guidance relating to foreign currency effects. One approach to handling foreign currency translation is to back out the revenue and expense effects to yield income statements that are not affected by these fluctuations. Because foreign currency effects are unpredictable and out of the company's direct control, we exclude those effects in a desire to better forecast operating cash flows. In this learning objective, we will analyze accounts receivable and uncollectible amounts. Selling goods on account carries the risk that some customers will encounter financial difficulties and be unable to pay the amount due. GAAP recognizes this possibility and requires companies to estimate the dollar amount of receivables that are likely to be uncollectible and to report only the net collectible amount on the balance sheet, as shown for Pfizer for 2017 and 2018. Companies frequently employ an aging of their accounts receivable to estimate the uncollectible amounts. An aging analysis groups accounts receivable by number of days past due, days after the scheduled due date. A common grouping method uses 30-day or 60-day intervals. The company then estimates the percentage of gross receivables that is likely uncollectible for each interval and applies that percentage to the receivables balances to determine the estimate of uncollectible accounts and the net accounts receivable that it expects to ultimately collect from its customers. To account for uncollectible amounts, companies use an allowance account similar to the ones we discussed for sales returns and other allowances. The allowance for uncollectible accounts reduces the gross receivables that are reported on the balance sheet. If we assume that a company sells goods on account for $100,000 and at the end of the accounting period estimates that $2,900 of that amount will be uncollectible, then the company would record bad debt expense that would flow through to retained earnings and an allowance for uncollectible accounts of $2,900 on the balance sheet. The net effect would be $97,100 of income reported in the income statement and net accounts receivable in the balance sheet. By setting up the allowance, that the company has established a reserve or a cushion that it can use to absorb credit losses as they occur. If a customer who owes $500 files for bankruptcy, the company would write off the receivable by debiting the allowance for uncollectible accounts and crediting accounts receivable. The write-off of the uncollectible account changes the ending balance in the accounts receivable and uncollectible accounts, but the net accounts receivable has not changed. Each period, the company replenishes the allowance account and then draws it down for write-offs. An important analysis tool for accounts receivable is to determine the magnitude and quality of the receivables. The relative magnitude of accounts receivable is usually measured with respect to sales volume, using either the accounts receivable turnover or days sales outstanding ratios. Days sales outstanding is arguably the most intuitive of the two ratios, as it reveals the number of days on average that accounts receivable are outstanding before they are paid. The DSO can be compared with the company's established credit terms to investigate if the company's customers are conforming to established credit terms. It can also be computed over several years to investigate trends, and it can be compared with peers. The ratios for Pfizer for 2018 are shown on this slide. A lower accounts receivable turnover, a higher percentage of accounts receivable to sales, and a lengthening of the days sales outstanding all provide a signal that accounts receivable have grown more quickly than sales. Generally, such a trend is not favorable. One reason for the trend may be that the company has become more lenient in granting credit to its customers, perhaps in response to greater competition, or perhaps the company is finding it difficult to maintain sales volume and is reaching for additional volume by selling to new customers with weaker credit scores. Another reason may be that credit quality in general is deteriorating. If existing customers are not paying on time, the level of accounts receivable relative to the level of sales will increase. This will be highlighted in the days sales outstanding statistic, which will increase as the percentage of receivables to sales grows. A third possible explanation is that the mix of products sold has changed towards markets with a longer payment term. The first step is to analyze the company's MD&A section of the 10K to learn management's interpretation of the adverse trend, and a second step is to review the financial press, analyst reports, and other external reports about the company to glean additional insights. The accounts receivable turnover and days sales outstanding for Pfizer over the period from 2014 to 2018 are highlighted in the Standard & Poor's Capital IQ report shown on this slide. It reveals that Pfizer's accounts receivable turnover has increased over the past 5 years, which is a good sign. The downward trend for days sales outstanding is another way to measure the positive trend. This metric has declined by 10 days over the period. Generally, the analysis of accounts receivable focuses on the level of the turnover and DSO ratios compared with peer companies and trends in these ratios. To assess the 10-day decrease in DSO, we could compare this to a set of Pfizer's peers. To analyze the quality of accounts receivable, we focus on the allowance for uncollectible accounts. Companies are required to report on their balance sheet the number of accounts receivable they expect to collect, including the gross accounts receivable less the estimated uncollectible accounts. Levi Strauss also includes Schedule 2 in its 10K, where it reports a roll forward of the allowance for uncollectible accounts that shows movement in the account. Over the 3-year period from 2016 to 2018, the company wrote off $7,112 while only increasing the allowance account by $6,124. Because Levi Strauss has not sufficiently replenished the allowance account for write-offs over the 3 years, the balance in the allowance account has declined. This would not be an issue if gross receivables decline proportionately, but that is not the case. The allowance account as a percentage of gross receivables has declined. There are 2 possible interpretations for the decline in the Levi Strauss allowance for uncollectible accounts. One is that credit quality has improved. If Levi Strauss believes the collectability of its remaining receivables has improved, it can feel confident in allowing the allowance for uncollectible accounts to decline. An improvement in credit quality might be plausible given that the recession ended during this period and customers are in a better financial condition. Another is that Levi Strauss is underestimating the allowance account. This is the more troubling of the 2 possibilities. Remember, Levi Strauss reports bad debt expense in its income statement when it increases the allowance account. Write-offs have no effect on profit. Only the estimation of the loss affects income. So Levi Strauss might be attempting to increase its profitability by not adding to the allowance account and thus avoid more bad debt expense. To determine which answer is more plausible for Levi Strauss, we could compare the ratio to other peer companies to determine if the ratio of allowance account to gross accounts receivable is higher or lower. However, it is difficult to precisely know the reason unless they are discussed in the MD&A section of the 10K or in conference calls with analysts. Because we know that managers do have latitude in the amount of the allowance they record, we can make an adjustment to the allowance for doubtful accounts for the average percentage of the allowance to gross receivables over a period of time. To do this, we would add the allowances for the periods under review and divide the sum by the sum of the gross accounts receivable for the same period. We can then estimate the allowance for doubtful accounts using the average percent for the past 3 years. This slide shows the calculation of the average allowance for Pfizer over the periods from 2016 to 2018. The sum of the allowances for each year is divided by the sum of the gross accounts receivable to determine an average of 6.617%. We then apply the average rate to each gross accounts receivable for 2016 through 2018 to determine the adjusted allowance amounts and determine the difference between the original allowance and the adjusted allowance. For simplicity's sake, a 20% tax rate will be applied in all years to determine the income statement effects. This slide shows the adjusted bad debt expenses and net income for 2016 to 2018 using the differences calculated in the previous slide. Using the adjusted amounts, the balance sheet effects are also calculated. Note that there are no balance sheet effects for 2018. Since the amounts are cumulative, they are already in the 2018 balances. We could have calculated our balance sheet average for any number of years reflecting similar conditions. The key is that we assess the credibility of the allowance account and bad debts and then adjust as necessary. In this learning objective, we will evaluate operating expenses and discontinued operations. Pfizer's income statement contained many expense and loss items. The amounts reported are typical of most companies. Cost of sales is the cost Pfizer incurred to make or buy the products it sold during the year. As goods are manufactured or purchased, the cost is recognized as inventory on the balance sheet until the goods are sold, at which time the costs are transferred into the income statement as cost of goods sold. Selling, informational, and administrative expense includes overhead expense categories. Research and development expenses for Pfizer would be an important expense to analyze because it must conduct research for new products. It will be discussed later in more detail. Amortization of intangible assets, such as the cost of patents Pfizer has purchased, is a non-cash expense similar to depreciation expense that is amortized over its useful life. Restructuring charges are the costs that Pfizer has incurred or expects to incur to restructure its operations. Such expenses can include the elimination of lines of business, consolidation of operations, or reduction in the number of employees, and will be discussed in Module 6. The income tax provision on the income statement relates to Pfizer's profits. These are taxes that will be paid to federal and state taxing authorities, as well as income taxes levied by federal governments and municipalities. Discontinued operations represent the operating profit or loss and the gain or loss on the sale of businesses that Pfizer has decided to divest. Last, the income attributable to non-controlling interest arises because Pfizer has one or more subsidiaries where it does not own 100% of the voting stock. Companies in many industries depend heavily on research and development for new and improved products and services. For these companies, R&D is critical because failure to offer cutting-edge technology can lead to loss of market share and even bankruptcy. Common components of R&D are shown on this slide. Accounting for R&D is straightforward because R&D costs are expensed as incurred except for general purpose property, plant, and equipment assets that are capitalized and depreciated as usual. Analysis of R&D starts with measuring R&D expenses in dollars and as a percentage of total revenues. It is important to compare a company's R&D spending with its peers. R&D is a significant expense for Pfizer as it seeks new compounds and drugs to bring to market. In 2018, Pfizer expensed $8,006 million or 14.9% of total revenues. Over the past 6 years, Pfizer's R&D expense has ranged between 13 and 16% of total revenue, in line with the 13.7% median for the pharmaceutical and biotech sector. Financial analysts usually aim to develop forward-looking predictions of a company's income and cash flow. To that end, analysts monitor new products in the pipeline and develop estimates of their ultimate commercial feasibility. For example, analysts following pharmaceutical companies frequently prepare schedules of all drugs in development and monitor closely the success of experimental trials. They also monitor patent expirations of existing products and estimate the impact on sales after a patent expires. The tax expenses reported on the income statement relate to taxes the company expects to pay to federal, state, and municipal taxing authorities, as well as income taxes levied by foreign governments. In the 2 years after the Tax Cuts and Jobs Act was passed in 2017, the tax provision line on U.S. companies' income statements gyrated wildly. In anticipation of the new rules that went into effect January 1, 2018, companies engaged in activities to manage taxes across years. Some companies reported significant spikes in tax expense in 2017, while others reported drastic decreases. More than a few companies experienced tax benefits, which served to increase reported profits. The effects of the Tax Cut and Jobs Act continued into 2018 as companies responded to the new rules by realigning operations and repatriating past foreign earnings. Pfizer reported a tax benefit of $9,049 million in 2017 as a result of the Tax Cuts and Jobs Act. Pfizer's effective tax rate in 2018 dipped to 5.9%. Neither the income tax benefit in 2017 nor the relatively low tax expense of 2018 accurately predicts the income tax expense that Pfizer will report in future years. Pfizer's guidance for 2018 to analysts projects a 16% rate. To forecast as accurately as possible, we must carefully read the information the company provides about its current and future income tax expense. From time to time, as strategy changes, companies will divest a segment of their business. When this occurs, or when there is a definitive agreement to sell the segment, the company reports the event at the bottom of the income statement by segregating income from continuing versus discontinued operations. The line item for discontinued operations includes both the net income or loss from the segment's business activities prior to the divestiture or sale, and any gain or loss on the sale of the business. On this slide, we can see from Pfizer's income statement the reporting of discontinued operations. In addition to segregating the amounts on the income statement for discontinued operations, companies are also required to segregate the assets and liabilities for the discontinued operation on the current and prior year balance sheets. Discontinued operations are segregated in the income statement because they represent a transitory item. That is, transactions or events that affected the current period and prior periods, but which will not recur. Many readers of the financial statements analyze current year financial statements to gain clues to better predict future performance. Investors are interested in income from continuing operations because that is the level of profitability that is likely to persist into the future. Likewise, the financial press tends to focus on income from continuing operations when it discloses corporate earnings. Accounting standards relating to discontinued operations have recently changed and have restricted the types of disposals that will be accounted for as discontinued operations. Under the new accounting standard, in order to be classified as discontinued operations, the disposal of the business unit must represent a strategic shift for the company that has or will have a major effect on the company's financial results, a major hurdle for companies to demonstrate. Consequently, the reporting of discontinued operations is likely to be less frequent in the future. Companies that report discontinued operations have experienced a marked change in operations at the strategic level. It is important that our analysis of performance captures the underlying persistent operations. To analyze return, Pfizer's ROE and ROA for 2018, and to compare to the 2 prior years, the appropriate earnings number is income from continuing operations. This measure reflects the results of operations measured on a comparable basis over the 3 years. Accordingly, the measure is also appropriate for forecasting purposes. Discontinued operations are excluded for all 3 years. In this learning objective, we will discuss pro forma and non-GAAP disclosures. This slide shows the fourth quarter earnings release for Pfizer in 2018. Notice that the information mentions adjusted diluted EPS, or earnings per share. What is this metric, and why does Pfizer report it? To arrive at the adjusted EPS number, Pfizer made a number of deductions and additions to its published GAAP financials because company management believes doing so provides a better measure of Pfizer's financial performance. Pro forma amounts such as this must be read and analyzed within the context of the GAAP statements. Companies frequently report adjusted income statements, sometimes referred to as pro forma income statements or non-GAAP numbers. The Securities and Exchange Commission requires in Regulation G that companies reconcile any non-GAAP information to GAAP numbers so financial statement readers can have a basis for comparison and can evaluate the excluded items. The SEC is mindful of the potential for abuse in pro forma income statements and cautions investors regarding their use. When we read adjusted income statements, it is important to remember that they represent management's interpretations of the company's financial performance. We must view these representations as such, not a statement of fact. It is only by a thorough analysis of GAAP financial statements that we can understand the reasons for and the implications of adjustments management is making with the pro forma statements. The steps as shown on this slide provide the basis for making a thorough and proper analysis of earnings. The purported motive for reporting pro forma income is to eliminate transitory or one-time items to enhance year-to-year comparability. Although this might be justified on the basis that pro forma income has greater predictive ability, important information could be lost in the process. One role for accounting is to report how effective management has been in the stewardship of invested capital. Asset write-downs, liability accruals, and other charges that are eliminated in calculating pro forma income often reflect outcomes of poor management decisions. Our analysis must not blindly eliminate information contained in non-recurring items by focusing solely on pro forma income. This is the end of Part 2 of the presentation for Module 5 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.